Hello, and welcome to this week's episode of Companies and Markets Weekly from Stockopedia. I'm Lawrence. I'm joined today by Graham and Roland from Stockopedia's Daily Stock Market Report. We also have the pleasure of being joined by Ed Croft, our founder and CEO. We've got a really exciting agenda for you today. First up, Ed, you published some new research onto the site about how the market reacts to different flavors of trading updates. So we're going to discuss that. We are then going to look at some of the more interesting news from this week. U Group is in two of our model portfolios, so we're going to take a look at that after its update this week. And we're also going to look at some of the news around the UK car finance saga. There's a few stocks that have been impacted by that this week, so we're going to have a brief discussion around those. So Ed, thanks for joining us. Do you want to introduce the research that you published this week?
Yeah, good to be here. I would say it's some preliminary insights from some ongoing research, and it's a theme that's been going on since before Christmas. I wrote an article titled Ahead of Expectations, which is a phrase that is very familiar to those who read trading statements every day, especially Roland and Graham who are here. And essentially, it's trading statement season. So coming back from the Christmas break, you are hit by a massive tsunami of trading statements. And this is particular to the UK market because we only have, for most companies, results that are reported every 6 months. And so trading statements are these sort of interim updates which really guide the market to whether a company is in line with the expectations or ahead of them or below them. Expectations being the broker forecast numbers for profits and revenues for the year, most of the case. So we decided to really investigate this because we're actually developing some improvements to the news service at Stockopedia and wanted to really dig into these ideas and see if the sort of UK environment around reporting trading statements really had some strong actionable signals for private investors. So in the analysis, I actually found that we're in the big hump of trading statements, which sort of ends at the end of this month. And then there's kind of a 2 or 3 week period where it goes very quiet. And then results season hits like a bang, and it's huge. And because so many companies have got their year-end date at the end of December, there's a big flurry now. So it's heroic what the guys are doing on the Daily Stock Market Report at the moment. But so yes, we kind of have dug into the last 2 years of trading statements, specifically to look for the price action on the day for different classifications of announcement from significantly ahead to significantly below expectations.
A lot of what you found seemed to center around the concept of post-earnings announcement drift. I'd love for you to introduce that as a concept, because I think that's going to frame a lot of the discussion that we have later on.
Yeah, absolutely. So what happens is that there's a lot of academic research on this, which basically implies that when a company announces that it's got an earnings surprise or its profits are above expectations, there's often a drift for the next 6-8 months in the direction of that announcement. And that's what we really wanted to dig into, because a lot of the research is US focused, and we wanted to see what happens in the UK environment, because it's slightly different here because of these semi-annual reporting periods. So what we really did is looked at all the announcements, trading statements, and had a look at what the first day jump was in price for different classifications of trading statement. So for example, you might expect a significantly ahead or materially ahead announcement to lead to a price jump, and obviously that does. And a significantly below is a profit warning, and below expectations is a profit warning. And we've done a lot of research on that in the past, and the price drops very significantly when that happens. So we found that yes, those jumps happen, and we found that the jumps are obviously higher for them or lower for the more significant those announcements are. And then we looked at the price drift over the next weeks and months up to 6 months later. And we found a very, very strong correlation that for significantly ahead of expectations announcements, the higher the jump, the more the drift was in the direction of the jump on average. And which I think was particularly interesting because psychologically, most people, when they see a jump in share price, and I certainly do this, I go, oh, dash, missed it. I knew that one was a good one. And then you go off and try and find something else that hasn't moved. And actually, it might be, given the research, a more rational decision to actually, use that as a trigger point for action and buying or holding and continuing to hold. So I think that's really the key insight here, is that these are giving you information on where share prices might go, or more specifically, about the expectation errors that the market has about a company. And I think I'd like to dive into that just for a couple of minutes, because what actually happens here is that companies that announce they're ahead of expectations, that means that broker expectations are behind. And one thing we've really found was that companies announcing they're ahead often announce that they're ahead again and again and again. And it's surprising how long it takes the brokers to upgrade their forecasts to actually match reality. And I think it's because they often it's a psychological trait that we get anchored on certain levels. And that happens with analysts who forecast too. They anchor their estimates at a certain level and often don't push them up enough on new information. So you then find companies go ahead, announce ahead again and again and again. And that's what leads to price trends and leads to momentum. So I think this is really, really interesting. And I think it's we should have more insights on this in the coming weeks.
Awesome. Roland, Graham, I know you've read Ed's article. Was there anything that really stood out to you as people who are, part of your day job is looking every day at these trading statements and how the market then reacts to the detail that's in them? What stood out to you?
I think one thing that I found interesting that I've seen a couple of times recently is Ed, the article talks about price jumps, and sometimes what happens, even an inline trading statement prompts a big price jump, and I think that's sometimes seems to be maybe a sign that the direction of travel on expectations is changing. And because I think what's really important here is not so much what the expectations are, but how they're changing and how people expect them to change. And when there's a mismatch, that you get these big moves. So with with Frontier Developments, the video game company, last week, they issued an inline statement saying they've had good sales of their latest game and full year results, and their expectations are not changed for the full year. But the shares were up 25% on the day, because it is potentially, or shareholders will be hoping, it's the end of a really bad run of results and profit warnings for this company. And so inline can be very significant too when it's accompanied by a price jump. And I think so that's quite interesting, I think, to something to look for.
Absolutely. Frontier Developments was a really big COVID winner. It had a huge run in those years from memory. I think it was in one of the NAP's portfolios for a while. I noticed actually after that change, and it's suddenly the stock rank has jumped after that jump too. So it's now back up into the 90s, having been down less than 50. So interesting that maybe it does mark the point. And I think what you say is very true, that what we found is that the jumps in price are leading indicators themselves, regardless of the classification of the trading statement. So I think there was one I was looking at, might be SRT Marine, which has got a very low ranking, but I think in the last year, right at the bottom, it came out with an announcement, and it led to the biggest one-day jump in the database we put together, which has then led to a huge increase in the share price over the ensuing kind of 6 to 8 months. So you're right to point that out.
We also had similar from CMC Markets today, which issued a very short and quite terse trading update saying it was in line and has dropped quite suddenly.
Yeah, that's true. But CMC is kind of funny in how it communicates expectations to the market. I think there's always a big mismatch there, which does provide an opportunity. Going back to Ed's article, the main overriding point is the value of momentum. To me, that momentum is a real factor. That the markets are not moving in a random walk. There's clear trends that do emerge. Ed mentioned Reach and McBride in the article. So sometimes you have these extreme situations, and I think they often lead to mismatches, because it's very difficult for investors to predict what's going to happen. analyst forecasts very quickly become out of date. So in the case of Reach, there's pension liabilities, and there's fears about the secular decline of that market. In McBride, there was a solvency concern which went away, leaving the shares free to recover in a very dramatic way. So both are kind of special in their own way. So I think when investors are getting involved in these situations, they do need to be aware that these aren't blue chips. These are not situations where analysts are predicting things within 1% and investors are predicting things within 1%. These are very sort of dramatic situations, but obviously I love to cover them. How I treat it in my work is probably I stay positive on stocks for longer than I really should if I was looking purely at value. But when things are going up, I suppose you have to let them go up. And then when there's a profit warning, and this is where I'm not comfortable because it's counter cyclical, or it's if a company gives a profit warning, I often feel like I have to cut my own sort of view on the company to make my own view more negative now because of the risk of another profit warning and a risk of negative momentum. And I don't like doing that because I'd rather be buying when things are getting cheaper and being positive on things when they're getting cheaper. But at the end of the day, you have to respect momentum.
Roland, obviously you've been covering a lot of the trading updates that have been analysed on the Daily Stock Market Report over the last month. As Ed said, there's been a lot of them. Are there any trends that you've spotted that have surprised you in terms of sectors or types of companies that have been announcing more in line or ahead of expectations than you've expected? Have there been more or fewer profit warnings than you've expected at this time of year normally?
Yeah, I think it's. I'm not sure that I've added it up exactly, but my general feeling is it's not been as bad as general sentiment might have suggested. There haven't been, at least I don't think I've covered that many really bad updates. Investors in some ways still seem a bit gloomy or skeptical, but a lot of the companies we've looked at, I think it's fair to say they're doing okay, and they seem to have a reasonably balanced view on the outlook. Obviously, one topical area and one area that could be interesting as the year unfolds is UK consumer-facing businesses that are potentially facing a big rise in minimum wage costs and national insurance. A lot of these companies, they've come up with estimates on what the cost is going to be, and they seem to be taking a fairly measured tone on what the impact's going to be and whether it will be manageable. Whether this level of confidence is going to be borne out by the results later this year will be interesting to see, but my feeling so far is that things don't seem really that bad, and it's the outlook for the year ahead seems reasonably balanced at the moment. I don't know whether Graham has the same perception or not.
Well, I'm concerned about the tax rises. There was a bit of a pushback in the comments where I was sort of worried about Wetherspoons, for example, where they estimate an additional £60 million cost from these tax rises, which after they've paid their interest bill, they haven't got much more than that in terms of profit left over in recent times. So, there's cases where I think because the tax rises haven't happened yet, everybody is sort of guessing what's going to happen. And I would be very worried about how companies are going to mitigate that. Will they be able to pass on the costs? I would say a supermarket would have a good chance, but other businesses, I'm not so sure, without impacting demand.
You're certainly seeing divergent share prices across some of the retailing sector. I think two in the Naps portfolio on the site. One is Currys and one's Kingfisher, and Kingfisher's gone totally the wrong direction. Currys, which seems to be benefiting, well, not benefiting, it's performing well at the moment on strategic change, and that's still uptrending. So it is interesting. One thing I spotted in the report this morning was that I think a third of the companies you covered were above expectations, and it's just an interesting point. I was speaking to a fund manager called Alex Wood of Kerno Capital, and he said that at the end of last year, because he monitors the sentiment across all the RNS every day. And he said he's noticed a real step change in sentiment, in management confidence, which he said the last time he'd seen that led to a 20% rise in the market over the next 12 months. Now, that's not a prediction. That's just me sharing intel. But I thought that was quite interesting. So you guys will be more on the pulse of the daily themes, though. So I don't know what you think.
We had a subscriber who commented said that the market seems particularly jumpy at the moment. Are we seeing that? Are we seeing not quite the same level of positive share price movement that we might expect, given we've got so many ahead of expectations updates? What? I know, Ed, you've been around markets for a while. You look at them sort of more top down. What's your take on this?
Well, I think, the UK is a pretty interesting situation because it's been so cheap for so long and it's so unloved. And, we are not yet necessarily seeing the inflows on the funds that can really make a difference here. But I think that there is a lot of under-research. There are a lot of under-researched companies. So there's a lot of misvaluation. There's a lot of expectation errors. And so we do see quite big changes. And I think that's probably a theme that will last for a considerable time until the investing environment normalizes. And it's an interesting dynamic here because you've seen the American markets absolutely fly, and the British markets have had a positive 12 months, but not participating in the same way. So I think it's all about expectation errors and a lack of research, and private investors make up an important part of the market at the small cap end, and which is very underinvested in institutionally. So these significant moves are significant and very important to monitor.
Roland and Graham, I'm curious as to whether, I think you touched on it before, Graham, where you said that you've covered companies that have issued a profit warning and you felt the need to downgrade your own view of that company in line with that. Are there any companies where you've resolutely stuck to your positive or negative view of the company, regardless of what's happened in the trading update?
I can be stubborn, and I've ended up arguing with my co-writers about it. 888, which became Evoke, is a company I'm a shareholder in, where it's highly leveraged, highly dangerous, and where I've still said, well, maybe they can get through this. Watkin Jones, I was discussing that in the report today, where it's a very concerning situation with their remedial works for the properties they've built. But I look at the balance sheet and I say, well, the balance sheet is a source of strength, so I'm still going to be reasonably positive on that one, while acknowledging the uncertainty around it. So there's lots of cases where, if there's a balance sheet argument, good or bad, I think that can trump the earnings. Because earnings tend to drive share prices in the short term, and even in the medium term. But if there's a balance sheet argument, bullish or bearish, that can have the final say. So that's where I would probably be stubborn in my view.
Yeah, I think what Graham said about balance sheets resonates with me as well, really, with a couple of examples of companies I've looked at recently. Then one was Vistry, which is the house builder formerly known as Bovis Homes. They issued multiple profit warnings at the back end of last year, and after they had some problems with cost overruns and delays to projects. And the latest update just recently was in line with their revised guidance, or their reduced guidance at the end of this year, and it did show some improvement in trading. I think completions were up by about 7% last year, but I took a fairly negative view on that, I think, because I think it's they've been I think there's some more risk emerging on the balance sheet, more than there needs to be, and more than some other house builders too. They're reporting high levels of debt, rising levels of unsold stock, and they're also kind of seem to be partly at the mercy of external partners for their developments, who have been pushing back on decisions. I don't know whether maybe they're waiting for interest rates to fall there, the partners. And against this backdrop, the management have been buying back shares as well, which seems to have contributed a lot of the increase in net debt last year. So I did take a fairly negative view there, despite trading improving.
One thing technically I'd say about Vistry or a stock like that that's seen a lot of profit warnings in a row is the amount of disappointed buyers at overhead prices in the recent period. It often can create quite a headwind for shares to really bounce back when you've got a huge amount of disappointed people who've bought at a higher price. So technically there's some headwinds there too, I guess.
This all reminds me of the quote about in the short term, the stock market being a voting machine, in the long term, it being a weighing machine. How long does this, Ed, this post-earnings announcement drift last? Like, how long does that effect last?
Yeah, it's Ben Graham. That's a great quote from Ben Graham, the father of value investing, who also taught Warren Buffett much of what he knows about value investing. And how long? So the voting machine, look, the momentum tends to persist for about a year. It's pretty categorically that price momentum and earnings momentum can reverse after about 18 months. So you tend to see the momentum effect. Generally, the sort of best timeframes for tracking momentum is that 6 to 12 month price history, share price history. If you find the kind of the ones with the best price momentum and in the trailing 6 to 12 month period, they often do really rather well. So that is really the kind of voting machine that goes on. And it's very interesting because often momentum is started by these announcements, ahead of expectations announcements, which chain and they drive that momentum. But then actually they stop, and often companies start reporting in line again and again, but the share price keeps powering on. And that's because, the momentum bandwagon traders jump on, and they also think and project things are going to go on for much longer than they do. And then you end up with the reversals. So that's really the way that mechanism works. And that's why the momentum rank works on the site, which is actually, funnily enough, has been the best performing of the 3 stock ranks.
If you had to summarize the take-homes for investors from the preliminary insights, and obviously we're going to share more insights as they come, what would those be?
That you should really always pay attention to ahead of expectations, and especially significantly ahead of expectations announcements. They often come out as materially ahead or substantially ahead, but they really are, there are quite few of them. And when they are mentioned, they are big turning points in stocks. I think U Group is one which, when it kicked off its big cycle of upgrades a couple of years ago and led to a huge run in the stock, it starts with a significantly ahead announcement, and then you get the ahead of announcements that chain on the back of it. So I think that's really key, and also looking at the price jump on the first day as a leading indicator of direction. They don't always work. It's not like there's one rule for everything. You have a certain percentage hit rate or win rate in these things working. And I think I was looking at it, and I think for significantly ahead, I think the data set I got in the last 2 years was 75% of shares continued in the same direction. So it doesn't always work, but I think those are the key takeaways.
Welcome back to part 2. We're going to look at some of the headlines from the news this week that Roland and Graham, you've been covering in the daily stock market report. Ed is staying with us because the first company we're going to look at is U Group. It's a small cap business energy supplier. It's also currently in Roland's Stock in Focus portfolio and Ed's new QVM portfolio. So we thought, let's have a chat about it. It's got very, very strong stock ranks, quality rank of 80, value of 81, momentum of 93, overall stock rank of 93 means it's classified currently as a super stock. Gave a bit of a mixed update this week.
Yeah, so in summary, I think the very short version is that growth was strong last year, but possibly less strong than expected, or perhaps a little bit slower in the second half of the year. But against that that possible negative, the company said their profit margins are going to be higher than expected, and that's really because of good control over their energy purchase contracts, their hedging arrangements for gas and electricity, and also bad debt, which is a key risk, I think, for this business. So the market took a bit of a negative view. I was more positive overall. I think that disciplined growth is fine for a business like this, because it's very easy for things to go wrong if the financial controls aren't tight enough. So, yeah, I think it's still an attractive growth situation at the moment. I don't know what you thought, Ed.
Oh, I mean, it's a fascinating situation. It's been on an absolute tear, and since I think late 2022. And probably one of the best performing stocks in the market since then. It's must be up 8 times or something like that, and it's been driven a huge amount of revenue growth. Just looking at the stock report from 80 million in 2018, revenues projected to be 657 at the end of this year. As you said, it was maybe a slight revenue miss, and then so I think they said revenue slightly below expectations, but I think profit slightly ahead. So what do you do in that situation? And I think. I remember, was it Gervais Williams at a conference was saying, talking about U Group last year and saying that he's always been astonished at how lowly valued this is. And he was, okay, he owned it. So he might be biased, but he was claiming the valuation should be 5 times higher. I think what's interesting about the company, look, it's a utility, right? And it's subject to all I'm not an expert on this at all, by the way, so full caveats, but it's got 80 million and maybe we'll have 100 million in cash by the end of this year, and 80 million at the moment, which is an enormous amount of the market cap. It's 30% of the market cap. And so I think on the forecast PE ratio, it's only a forecast 7.5. You take out the cash, it's forecast 5, and it's growing strongly. I think the thing I'm concerned about, if I'm honest, you often see in these fast growth companies a culture of sales. And we've seen this time and again, that when a sort of sales culture can take over, because they're doing all these smart meter installations and they're extraordinary growth. I don't know what the number was, but it's more than 100% in the last year or something like that. And they're installing these things at a real clip. But what I've noticed is that there are some quite bad reviews online. If you go on Google reviews or Trustpilot, you see very negative reviews about the company's sales practices. And that would be my worry here. And I think like every sort of number is quite super, the numbers are very impressive, very high stock rank, but there is a risk. And I think the risk maybe is, on that sales side, but they do seem to be riding a bit of a tailwind. And, but the market didn't take very kindly to it. I think it was down 8% yesterday or so, but it's a very fascinating situation.
Does the update change any of sort of those fundamental trends that we see if we look at its financials?
I would say it's still, just looking from a purely data-driven technical perspective, and I'm not going to, make a fundamentals call on it, but it's still in an uptrend. It's still in a long-term uptrend. It's got high rankings. It's spitting off cash flow. It's generating so much cash. They're going to have to do something with that cash. And, if I don't know what they're going to do with that cash, but if I had all that cash, I'd start buying back stock or paying it out to shareholders. Because, if the market cap's 265 million, and if they're going to have 100 million on the balance sheet by the end of the year, that's extraordinary. So, there's a real deep value case here as well as the other cases. So, very high profitability measures.
Yeah, I think that's one point I'd pick up on. The profitability seems to be improving, and that's a really positive factor for me. And it could be, I think, a positive for the valuation too. Generally, I suppose you can't generalize completely, but a more profitable company, there's more of a reasonable argument to support a stronger valuation, I suppose. I think one point with the cash is that possibly some of it is one of those businesses that does need to have a decent amount of liquidity. I think perhaps because entering into hedging contracts for their energy purchases and so on. I know that one reason why the cash rose so much last year from about 30 to 80 million, roughly speaking, net cash, was because around 50 million was returned from their previous trading counterparty. They changed to a new arrangement last year with Shell, which they say is much more effective, efficient, and scalable for them. So I don't know whether that means they'll need less liquidity going forwards than in the past, but I think it's one of those businesses where you wouldn't want to see them running up a debt balance, or at least I wouldn't as a shareholder. But yeah, I think the improved profitability, the valuation seems modest. And as you say, the risk really is that some other unforeseen issue happens, maybe reputational or whatever, that brings their growth to a sudden halt, which would probably have a nasty impact on the shares.
Definitely.
And this isn't a business really that I'd want to pay a very high multiple for myself. It's a utility. There are things that can go wrong, and it has to turn over a great amount of money to make a reasonable profit. And as I say, with business, it serves the SME business market in the UK. So it could be affected by the economic cycle, a rise in bad debt, for instance. A small increase could have a big hit on profits. So I think it's a measure of caution is probably sensible, but I think it's, financially still seems to be performing well.
Obviously, U Group is in both the SIF portfolio and the QVM portfolio. Is it still in those? Is it getting close to meeting any of the sell rules there?
In terms of the NAPS portfolio, which is morphing into the QVM, it is actually now the worst performer year to date, down 10%, but that doesn't trigger anything. It's not a profit warning. So I will be monitoring that and monitoring whether it does start to trigger sell rules. I mean, one thing I'd say about a company like U Group, we have a risk rating on it, which is speculative. And speculative is the second highest top risk classification of shares in the market. And what that actually means is it's very highly volatile. And actually, you expect the standard volatility through the year to be somewhere between 45 and 70%. So it being down 20% is actually normal for this company. And so I wouldn't say it's out of the bounds of a typical downside volatility in this business. So in the share price. So just thought I'd flag that.
For me, my timing was slightly different. I bought the shares in October and added them to SIF in October. So I'm still just about in positive territory. And unless there's a profit warning, my sell rules, I won't be looking at selling it until much later this year, when it'll be due for a review.
Lovely stuff. Moving on, Graham, to the other big bit of news this week that you covered. There are a bunch of lenders whose share price reacted very, very strongly to some news that came out. I'd love for you to summarize what's going on there, if you could.
Yeah, sure. So we had big movements in motor finance. STB, the Secure Trust Bank, was up 33% on Wednesday. Close Brothers was up 22%. And my old favorite, S&U, with the ticker SUS, was up 15%. Even Lloyd's was up 4%, which is a big move for Lloyd's. And it's all to do with Rachel Reeves and the Treasury, who are making an intervention. They want to give evidence to the Supreme Court because the Supreme Court is reviewing a decision by the Court of Appeal from November. This is strangely not an FCA matter. This is the courts sort of doing their own thing, if you like, and they have discovered that car dealers have a fiduciary responsibility to customers when car dealers act as brokers to a loan. So you may remember that there was this other issue about discretionary commissions. So when you buy a car and get a loan, that the commission received by the car dealer acting as a broker would vary depending on the rate that the customer paid on the loan. That is a separate issue. This issue is about the presence of the commission in the first place, and whether the car dealer should be getting fully informed, active consent from the customer about the presence of a commission. This issue has been of great concern to motor finance, and it looks as if the Treasury are going to try to get some kind of what they would call a proportionate action by the courts, where there was not some windfall, as they put it. They're trying to prevent another PPI sort of situation where, costs run into the billions. It could drag on for years. I mean, I guess it probably will drag on for years anyway. But it's an example, I suppose, of one of the risks you have in banking, where these things can crop up, and it's very difficult to quantify the risk because nobody knows what the penalties or compensation might ultimately be. Now, one of my faults as an investor is that I tend to be fairly positive on cheap companies, even when they have a lot of regulatory risk. So I've been reasonably positive on the likes of Close Brothers and S&U. S&U has had the FCA all over it for ages, and Secure Trust Bank, exposed to this problem about potential compensation. But these companies and their stocks are trading at extraordinary levels. And I know the UK banking sector has been very cheap for a very long time. But if we've got subscribers listening to us, go on Secure Trust Bank's stock report. Look at the value rank, 99. Look at the metrics that create that 99 stock rank. It's all green. It's all green to the max because this thing is in the mud. And if the courts don't hammer it, I think there's an opportunity there. But that risk, I previously compared it to the sword of Damocles. Who knows how hard it will strike? But I think with that Rachel Reeves announcement, we've got hope. And would the courts and the government really stand by and watch, and these companies get destroyed by a court ruling over an issue that nobody really thought about before? Maybe, but I doubt it.
It's amazing looking at the range of cheap measures on the site. I'm having a look now. You're totally right. It's trading at a quarter of book value, a quarter of tangible book. It's less than free cash flow, 60% of free cash flow. P ratio 1.8 forecast. It's this is a proper Ben Graham bargain, isn't it?
Is this a commonality among these sort of real bargain bin stocks where there are? Graham, you said basically it's hard to quantify the risk here. Maybe we saw something in that in the share price reactions on the days. Like some of the smaller ones were up massively. Lloyd's was up. Clearly, some people think that this has materially shifted the risk reward profile, but it feels like among these bargain bin stocks, that's a really hard thing to do. Potentially you need some real specialist knowledge to be able to properly evaluate the risk here. Is that the case?
Well, I think you need a crystal ball probably, because nobody knows. But they have been impacted. Their profits have been impacted by the FCA. But I think that FCA issue is also going to be resolved. That because I suppose part of the problem is there's so many investigations. The FCA is very concerned about consumer duty and customers in financial difficulty, and it has been forcing these companies to treat their customers in financial difficulty with great care. Now, I believe that S&U, for example, they already treated their customers with great care. I don't know so much about Secure Trust Bank, but I do know that the FCA has allowed collections activity to go back to normal. So I think that these investigations are definitely a problem for investors, but maybe it's worth a gamble. I don't currently own S&U. I owned S&U in the past, but there's some great bargains out there. Maybe the way somebody might do it would be spread the risk across a whole bunch of them. But I think it's very, very interesting.
Just the one thing I'd say on situations like these, we were talking about Ben Graham, and we did write up actually in the Academy last year a big article series called the Strategy Map, and there's a piece I wrote in there, quite extensive. They're long pieces on deep value. Because these Ben Graham situations, it feels like in this sort of sector, and whether he would always say you get your safety through the diversification of owning quite a few of these. I think it's very brave to dive into one stock like this, which might be a very binary situation, but actually you can get that. Often these sorts of situations have a very positive return on average across sort of diversified portfolios. So, and that's not encouraging people to buy all of these shares, which would be a huge single sector bet. And but that's just something I thought I'd leave on.
Of course, I will link to that article series from the Stockopedia Academy in the show notes. That's all for today's episode. Thank you so much for listening. Graham, Ed, Roland, thank you for joining me. I've really enjoyed it. If you have enjoyed the analysis and the research in today's episode, I think you will really enjoy our content on Stockopedia, including the daily stock market report and regular content posted by our other analysts, including Ed. You can access it for free for 14 days. There's a link in the show notes. You'll also unlock the rest of our stock market research platform, including all the tools, insights, and education you need to help speed up your research process and help you make more informed investing decisions. We'd also love to hear what you thought of this episode. There's an email address in the show notes. I'd love for you to email in and let me know your thoughts on the episode, any questions you have, or you can get in touch with us on Twitter or X. We are at Stockopedia on there. That's all. Thank you very much for listening. We'll see you next week at the same time for the next episode. Bye for now.